here from Chicago. Good afternoon, everybody. It's nice to, really excited to be here in Boston. I see some friendly faces out there, so that's always nice. We picked the rainiest day possible so we could all just be in here and do work and get deals done. So if you're new to Opus, I think that you'll find it refreshing. I've had a great relationship with Opus for the past few years. It's a very highly productive use of your time for networking. If you're like me, you got limited hours in the day, and if you're taking time out of your day to go do networking, it's nice to actually feel like you're getting something done. I think you'll get a chance to meet a lot of substantive relationships, make good connections, as opposed to paying a bunch of money and just getting some free snacks. So it's very productive, and great to be here in Boston and to see a lot of members of the great finance community here in Boston. So look forward to talking to everybody later today. We've got a great panel, a mix of debt and equity. I'm going to sit down. So my job is to just let these guys introduce themselves and then moderate. I think everyone can hear me. Is everyone okay with the audio? We don't have microphones. If you're having trouble hearing, or if you're having trouble hearing any of the panelists, maybe just give a heads up. Mrs. Hoyer in 5th grade told me I was really a loudmouth, so I'm just going to assume that you guys can hear me. Without further ado, we'll go ahead and introduce themselves. My firm, we operate mostly as a placement agent, so I get to interact with capital providers across the spectrum. We probably about 2/3 of what we do is helping lower middle market firms, private equity firms, and independent sponsors either buy a company or do recaps. So I get to be familiar with lots of different people. So when I come here, I see a lot of folks. I kind of have a good idea of what your firms do, but don't assume that everyone else in the room does. And so that's really what we want to just get to know these folks right away. So just to my left, we have Kenny Smith. Why don't you tell a little bit about you and your firm and what you guys do?
Thanks, Phil. So, as I said, my name is Kenny Smith. I work at Crystal Financial. Crystal is a direct lender. We focus on asset-based and cash flow loans, $10 million and up. We seek to fill the void between where the senior bank market traditionally ends and where the more expensive mezzanine debt begins. So to do so, we provide first lien, second lien, unitranche, and variations on that, last outs, bifurcated lien structures to effectuate transactions in a number of industries. We're generalists. We do a lot in retail. We have done a lot historically in specialty finance, but we have, over the 11 years Crystal's been around, we have done a lot in pretty much everything you could name: business services, manufacturing, media, transportation. So we really run the gamut. I think that's about it.
Great. Thanks, Kenny.
Yeah. Hey, Warren Bonham, partner with Inside Equity. We're located in Dallas, Texas. We've got a satellite office in New York as well. So we are right now investing out of our third equity fund, so $640 million. We've got another colleague here, Luke Bateman at the back, who just closed a deal for us, I think it was last week. So with that deal, we're a little under half invested, so plenty of dry powder left. So if we can do some deals this afternoon, that'd be terrific. We are control investors, so we'll go down as low as 51%, but definitely want to be in a control position. From a size standpoint, we tend to look less at EBITDA, though it's got to be at least positive EBITDA, but we look more at revenue. Ideally, EBITDA will be on the low end because we think we can do some things to sort of improve that and create value down the road. But for revenue, $50 million on the low end would be a hard cutoff for us. Ideally, a little bigger than that, at least for a platform investment for add-ons. Pretty much anything's fair game. On the high end, maybe up to $500 million of revenue would be probably pushing it a little bit. From an industry standpoint, we like companies that basically industrial companies would be the power alley for what's made us successful in the past. Although we would look at almost anything. You got to get a little more. Definitely tougher to put money to work these days. We get a little more creative now than we did, probably 10 years ago. A couple of things we won't do. The 3 R's, as we call them. So yeah, we wouldn't do real estate, restaurants, or retail. But virtually anything else, I think, would be fair game. But really, where we cut our teeth would be things that are maybe operationally challenged companies more in the industrial space. So yeah, that's those are the highlights at least.
Great, thanks, Warren. Vipul?
Hi, Vipul Shah. Good afternoon, everyone. I'm with Aeromark Partners. We're a firm based out of Denver with offices in New York and in California. I'm based out of our New York office. I work with our direct lending team. We are focused on financing growth for small U.S. businesses. That can take the form of debt, equity, so we're capital structure agnostic with a debt bias though. So for us, businesses starting as low as 3-4 million of EBITDA and going up. But the key characteristics we look for is growth. The second thing we look for is it an industry we understand? And so a lot of our team has operational background and industry expertise. Most of my career I've been an operator and an entrepreneur. So we'll look for things that we understand. So it's an esoteric set of industries. So first is software enabled. So as long as there's some software involved in running the business, we're interested in talking about it. Second thing is franchisors. Tends to be more the Planet Fitnesses of the world or the Kentucky Fried Chickens, not doing high-end things. So they're less cyclical. Healthcare IT and healthcare services, we don't take a lot of reimbursement exposure. And selectively, we'll look at certain business services deals. And in terms of the types of folks we typically partner with, we are predominantly focused on partnering with founder-owned businesses, family-owned businesses, or independent sponsors. And from time to time, we will also partner with private equity firms.
Great. All right, thank you. So as you guys can see, we've got a pretty good mix up here of debt and equity, different types of capital, different ways to look at things, but pretty much all focused in broadly what I would call the lower middle market. We are going to attempt to tackle this this conversation topic of relationships today. So pretty much everywhere I've ever worked in this industry, people have talked about relationships. So we're going to try to give a little definition to that. What does that really mean to have a relationship? And then as I like to talk to borrowers when they're entering into a transaction, whether you like it or not, you're going to have a relationship. So what kind of things are you looking for, and what is the value of a relationship, and then how do you differentiate yourself in what we all know is a pretty crowded market? So we can just jump in there with Kenny. So what are some of the things that you're looking for in a business partner and in a new relationship?
Yeah, I think there's a couple things that are important. One is usually, though not always, a track record. You want to see that they've done transactions either within the same industry or of a similar capital structure, or having some similarities to the deal that's being contemplated now. Now there's been a proliferation of new firms on the debt side and on the equity side, so it doesn't mean that we won't work with new firms. I actually think that's a great way to generate opportunities in a very competitive market. But we do want to see that the principals of that firm have had meaningful experience in whatever the types of transactions are that they're doing. That lends itself more to the sponsor side. We also do non-sponsored transactions. In those instances, you're not necessarily going to have the track record. You may have a company where the management team has been there for a long time. But I think in those instances, you're going to look even more so to the management team, to their competency, to their integrity, so that you know who it is you're going to be dealing with. I think in the part of the market where we operate, we do a little bit tougher deals. Some are tough because they're high growth and they're going through growing pains. Some are tough because they're in a situation where it could be a little messy, could be a turnaround, could be a restructuring. In those instances, you really want to be comfortable with the people that you're working with. You can't always predict what's going to happen, but you can fairly certainly predict something's going to happen. And so the competency and the integrity of the sponsor, the management team is crucially important. If we worked with them before, that's fantastic and that's really helpful, but of course that can't always be the case.
Great. Warren, obviously it's different type of capital, different. So what are some of the things that you're looking for in a relationship?
Yeah, so I guess we think about relationships in a couple of different dimensions. So one would be certainly from a deal sourcing standpoint, but almost as important as that would be from a financing standpoint. So we can talk a little bit about both of those. But from a sourcing standpoint, in an ideal world, we'd come up with great creative ideas that nobody's ever thought of, and come up with proprietary deal flow and things would be wonderful, but that tends not to work all that frequently. It works fairly well, to be honest, with small add-on acquisitions, but for relatively scaled platform companies, it's probably unrealistic to think that's going to be how we make our money in the future. So most of our deal flow really comes from guys like out here in the audience today. So really working on those relationships and developing them is critically important for us. We don't get that kind of the flow of deals coming across our desks and whatnot. We're not going to be successful in putting our money to work. And just looking at stats, not too long ago, there's probably double the number of guys like us, now as there was 10 years ago. So we know that, we have to be front of mind for, investment banking partners for us to get access to the deal flow. Where it's just not going to happen automatically. It's something relationships, whether it's a marital situation or more of a financially oriented relationship, it takes work. And we think it's important for us to put a lot of energy into whether it's events like this or just sort of building and fostering those relationships so we get access to the deal flow. So and actually I don't know how many people have used a data source called Sutton Place. I don't see a lot of kind of nods out there in the audience, but it's a pretty good data source that tells us kind of what % of the deals that close, in any given time period, we're actually seeing. And the first time we looked at it, it actually surprised us in that I think the original figure we saw was somewhere in the deals that are in our size range and our industry focus, it's probably about 20–25%. Very low penetration rate. We thought we were, seeing almost everything that was out there, but obviously, there's a lot of white space that we're not seeing for a lot of reasons. And that's a metric that we can use to try and track how our relationship building efforts are progressing. And over time, it actually has gone up, but it's still not where it needs to be. From a lending standpoint, probably we definitely do not want to put all our eggs in one basket. So we like to spread those sort of lending relationships around to an extent, and try new lenders on different transactions and that sort of thing. But really the acid test for us is what happens if we hit kind of a speed bump in the road. Not all deals go, straight line from point A to point B and, 10x returns and everyone's happy. Some of them have a couple of speed bumps between A and B. And sort of what happens in those difficult situations really is where we define whether relationships are, more transactionally oriented or if we really do have a relationship with a lending partner. That's probably the most important thing that we would consider on that dimension.
Vipul, so topic of relationships, so you probably do business with new relationships, people that you've never done business with before, and existing relationships. Talk about that.
Yeah, I really like the way Warren framed out the different constituents. For us, there's also 3 core constituents. One is going to be folks that are in the audience, who, as much as you'd like to have every deal be proprietary and sourced by yourself, it's just very difficult to do. So a lot of our deals come from law firms, accounting firms, brokers, bankers across the nation. So one of the things we found as a good glue for that relationship is we pride ourselves in being the fastest no and the firmest yes. So we know that you have people that you want to show the deals to, you've got to get the deal done. Or if for a law firm or an accounting firm, it might be a long-standing partnership and you're just trying to guide your client into the right outcome. So one of the things we've done is set up our process in order to maintain these relationships in a good way is how can we get back to you within 2-3 days? Does it fit? Now, part of our narrow focus in terms of industries allows us to do that. Sticking to our knitting in the lower middle market allows us to do that. So for us, if we can be the fastest no, but then when we say yes, we're a firm yes, because we've gone through investment committee, we've gone through all our process. So we've made it a very iterative process, and that's helped a lot with relationships. We feel if you can hear no from us quickly, you're more likely to call us back because we've respected your time just as much as we want others to. The second constituent tends to be the private equity firms we work with. So we do mostly sponsor, but we do partner with private equity firms. And there, it tends to be industry focused. So our core goal is we don't have a sponsor coverage model. We do not reach out to private equity firms. But over time, we'd like PE firms to know, here are the very few verticals where we have deep domain expertise in. So there, because most of our team has an equity, operating, and a credit background, we tend to co-diligence with our sponsors and be really involved in the process of winning the deal itself. So those relationships require staying top of mind, like Warren said, and on what our industries are and the area, the size we're focused on. For those, we just remind that if it's middle of the fairway, probably not for us. If it's growing and you really want to accelerate the growth, and there's going to be some nuances to contend with, we tend to be a better partner because we understand enterprise value, we understand growth. We do like EBITDA just like you guys do, but we don't obsess purely on EBITDA. We feel, and the last constituent, which is where we spend most of our time, and that tends to be family offices and founders. And for there, what we're looking for is alignment, domain knowledge, but the biggest thing that brings us together is how can we add value. So our opening comments for founders and families that we work with to help grow their businesses is, can we add value for you? And let's both agree how we're gonna add value, because if we can, then that's gonna work. So for us, that area has been great because that has a network effect. You do a phenomenal job for a private equity firm. I doubt Warren's gonna call his next best competitor and say, wow, Vipul is awesome, Aeromark rocks. You should call them on the next deal when we're bidding against you. But families and founders do. So for us, being the fastest no and being respectful of their time for our families and our founders, they do call each other. Last year, we closed 3 deals that were a direct connect referral from CEO to CEO to CEO, all non-sponsored deals, all direct investments, where in most cases we are the first institutional capital. So fastest no.
Great, thank you. All right, so enough of these easy questions. Now we're going to get hard. This is really going to get, so I think as you alluded to, Warren, all relationships go through ups and downs, right? And I think the true test of any relationship isn't when everything's going great, right? The company's having their best year ever and everybody's making lots of money. It's when there's bad news. And I think eventually all of you get into those relationships. So how do you handle that? Maybe you have, you've done a deal with someone before, you do another deal, and this one's not going that well. And the last one was great. We never had any issues. Or maybe you have 2 deals with a group, and one's going great, but the other one's not going so great. How do you handle those tough conversations? And then I would like to hear specifically, like inside your firm, is everyone involved? Is there a special process that you go through, or is it just success has a 1,000 fathers and failure's an orphan, and everyone runs for the hills? So go ahead.
You want me to start? So, as the lender who sometimes is lending into more difficult situations, a lot of times, my job is as an originator, which is to find the deals. And so your bifurcation of the relationships was really good. You have the relationships of where you find the deals, and then you have the relationship once you're in the deal. Now, for us, we source a lot of things from private equity firms and from other lenders. We do investment banks and consultants as well, but oftentimes those 2 are one and the same. However, when I'm on the front end of a deal, or just getting to know a sponsor and talking through what it is we do, many of them frequently ask, how do you guys behave in a situation where there's default? And so what I like to tell them is that we're a firm that does healthy growing businesses, but also with the asset-based component in particular, it lends itself to tougher restructurings, turnarounds, dip loans, tougher situations on the whole. And in those instances, we are very used to being in situations where there's a default. It doesn't cause us to freak out at the first sign of trouble. We're used to it, and we've done it for a very long time. It's the same people working on the tougher deals as it is the healthier deals. And so we're able to say, look, we know how things can go. When you're doing a transaction, be it a new one or a bolt-on, things are going to happen. We're prepared to work in a sort of level-headed way around those situations. And then we like to provide examples. Here are businesses that didn't grow at a hockey stick the way it's said in the sim. Here's how we behaved in that situation. Feel free to talk to those individuals. And that helps us develop the relationship up front, gain some trust with our partners, and hopefully win business. And then when it's in-house, you actually have to behave that way. And I think our history allows us to do that in a way that allows us to continue doing deals with parties that we've done deals with in the past.
Great. Thanks.
Yeah, so I guess for us, I mean, we try and do our best at the outset before sort of getting into bed with somebody, so to speak, to diligence what might happen if things don't go, as smoothly as you'd like it to. You can't do that perfectly, obviously, but yeah, we'll try and ask some of the questions, how would you think about this sort of situation, which you generally get answers that you want to hear at that stage. It's hard to kind of see through it exactly, but yeah, do reference calls and things like that. So yeah, like to do a little diligence beforehand. But then when you're hot and heavy and something unexpected happens, I think the couple things we tend to do, we always operate with, say no surprises. It will be a surprise to a lender if things aren't going perfectly well, but yeah, we don't sort of hoard bad news and share just good news. So if there's something bad that's lurking on the horizon, we be as upfront and transparent as possible. And that generally buys you a lot of credibility. And then we certainly always will, put everything we've got and double down on our, resource intensity and steal every analyst within the firm to kind of jump on that transaction and hopefully build some credibility that way. And then, but expect our lending partners to kind of do likewise as well. So not just a one-way street, but make it more of a partnership and a two-way street in those tough situations. And we always, the last thing we want to do is hand the keys back to somebody. So we do support our companies probably maybe more so than some other PE guys out there, just because the reputation is all you've got at the end of the day. And if you don't have a good reputation in the lending community or in the community more broadly speaking, you're not going to be getting the deal flow you want to get and closing transactions, getting maybe some stretch with the financing terms and things like that. So those would be a couple of the things that we would do once we're in some hot water. And then, but if we're doing those sort of things, we expect our lending partners to be doing comparable things and making commitments on their end, and not sort of the default being just supported with more equity is kind of the first request. Try and work through some more creative solutions at the outset. And if things continue to go poorly, equity might be a fair solution at that point in time, but not have that be sort of the default prompt. So those are at least some thoughts on that dimension.
Thanks, Warren. Bipple?
One of the things we try to do with, particularly with our focus on growth and working with founder family-owned businesses, we don't always have, an equity investor at the table. So when we get involved, one of the things we try to do is spend a lot of time early on saying growth is great, but the flip side of the growth can be volatility. And so we try to anticipate some of those things in the mix. So in order to let a business grow, you've got to have flexibility in there, allowing them to invest in the business, continue to grow it, which sometimes can mean, investing into something you think is going to work out, and that may not work out, and that happens. So by virtue of staying very focused on industries that we understand, one of the things we found to be helpful, and most entrepreneurs and families we work with welcome this, is we'll put in circuit breakers or early warning indicators. So one of the things we found is if you can get ample time. So if it's a software company, we're less likely to focus entirely on the leverage covenant. That's important. Free cash flow matters. All those things are important. But if it's a software company that's historically had 99% revenue retention rate, if that moves even by 1.5%, something meaningful is going on within the business. So what I mean by circuit breakers is if we put that in, then it's merely just a conversation with the family or the founder saying, hey guys, something's off. Let's start monitoring this together closely. 60-70% of the companies we invest in, we're on the board in some form or fashion. And so we'll start to say, guys, something doesn't look right here. We know the industry. Let's start monitoring this very closely. How can we be of service? How can we help? So our first mode of operation is just, how can we identify early on what are those volatility factors that could happen given the type of growth investing that's occurring? And for us, the growth comes in form of organic, which usually is a lot of OpEx investing, or it's add-on acquisitions, and the integration that comes along with that. So that's how we tend to look at it. And let's say, despite all those things, something goes awry, and it's going to happen. It's mathematical certainty. And so when that does happen, we tend to all come together. We're a small team, and everybody's familiar with every company we invest in. We partner closely with the teams, and they know most of the people on the team. And they will have met every member of the investment committee by the time we invest in the company. So we all come together and we try to add value in the areas we can. We like assigning a champion, usually somebody that's had good proximity to the deal, so that way for the company it doesn't become inefficient, or for the sponsor it doesn't become inefficient. And if you're dealing with 5 different people, but we do not have a workout group. We have a lot of workout experience, we have a lot of operating experience, so we found that just corralling the team together works well.
Reminded me of one comment, yeah, the workout comment. So in the relationship context, yeah, we think we have great relationships at the outset with our new lending partners, et cetera. And you work on fostering those relationships through all sorts of different mechanisms. But we truly appreciate lenders who do not have workout groups, because the relationship building efforts are kind of irrelevant once it goes over into workout. Totally different cast of characters with totally different set of incentives, and you lose control of there is no relationship building with folks in that sort of world. At least that's been our experience. So that's another criteria that's important to us, the guys who tend not to have the workout groups, or the guys who tend to get more of our business.
Yeah, that is a good point. We're in a situation where we see deals that sometimes that downside scenario that you underwrite to might actually occur. And I mean, I guess that's true for everybody, but perhaps the frequency is higher where we are in the capital stack. And so it's imperative. Our head of credit has always mandated that the people who underwrite the deals are the people who manage the deals, are the people who work the deals out if that comes to fruition. We don't have internal counsel to review documents. You need to know the letter of every document. You need to have the relationship with the counterparties. You need to be able to handle that at any stage of the life cycle, and that's important.
Great. We're at year 8, 9 of the economic expansion. There's no workout groups right now. No, just kidding. All right, so let's switch. We got about 10 minutes left, a little bit more than 10 minutes left. So let's switch gears and talk about differentiators. And we're in a room of capable professionals. We're in Boston, one of the larger financial communities in the country. Pretty much across the spectrum, whether it's private equity or mezzanine debt or senior debt, whatever capital, there's competition. There's a lot of competition. Not surprisingly, we hear from lenders all the time that there's too many lenders and not enough deals. So how do you handle that? What do you do? How do you market yourself? How do you differentiate yourself? Where do you get clients from? And just with the assumption that there's always going to be competition.
Yeah, there are definitely too many lenders and not enough deals. I mean, I've heard a lot of different stats, but since the last credit crisis, there's been hundreds of direct investing firms and funds that have opened, and tens of billions of dollars have poured into it. So just in the niche of the lending world where we operate, we have hyper competitive scenarios now, and so it's not easy. We do a couple things. One is I try and stress the flexibility of our firm. We do both asset-based and cash flow. Not everybody does that. That is, there are plenty more people who do it now than 5 years ago, but still that is a bit of a differentiator. We happen to be owned by a BDC, so when we top out at a $40 to $50 million check, if they like the deal, we're able to split that deal and do 100 or more all in-house. That's great flexibility. We also have an SBIC fund, which lends itself to smaller transactions, so we can do $10 million loans. It gives us pricing flexibility there because the economics of an SBIC are excellent. So it gives us an ability to price deals lower than we may on our balance sheet. So I like to stress that to people as to show us a meaningful amount of your deal flow, and I think we may have a way to get that deal done. The other piece of it is what we've been talking about today, is the relationships. And we have done 11 sort of platform transactions this year. 10 of those are with people that we have either done a transaction with one of the principals or have a very close personal relationship with one of the principals. So that could be the investment banker running the process, the sponsor whose deal it is, or a lender that maybe is agent or otherwise helping lead a process. And so going to people with whom they truly know you and don't just see you at events has been hugely helpful for us in a market where it's difficult to get as much traction as we have in years past.
Great. So I guess, yeah, at Insight, a couple of things that we, as we get into discussions with deal sources and that sort of, and lenders. A couple of things we try and highlight are operational expertise and capabilities. So we tend to run towards transactions that may scare some other guys away. So if it's got a little more hair on it, if it's a deal that is growing astronomically and has 25% EBITDA margins, it's going to attract a lot of attention, and we're probably not going to win that kind of an auction situation. If it's one that's got a little more erratic history and maybe some EBITDA challenges and that sort of thing, those are where we would be probably attracted towards a situation like that, and it might scare some other PE shops away. So we like that type of situation, and those tend to be more limited auctions. So if investment banks are having trouble moving a certain asset, show it to us, and we are likely to be interested. So that tends to be a differentiator. And then also we are, of the Fund 3 that I described, $640 million, we're 23, inside equity employees make up about 23, almost a quarter of that money is our own money. So we certainly care about it when it's limited partner money, but given that we are the biggest investor collectively in that fund, we're going to give every investment, everything that we've got, and the last thing we want to do is give the keys back to somebody, because a lot of that money would be our money that gets flushed down the toilet. So I think as a result of that, we probably support our companies maybe a little more than some other PE guys would, which I think is a big benefit, certainly in terms of getting deals done, but also with our lending partners. The fact that we are a big part of the capital going into these deals, I think makes them feel a little more comfortable.
For us, the differentiator is when we're working with a private equity firm, it tends to be our domain knowledge, growth-oriented mindset, and enterprise value-focused underwriting approach. So that tends to be every sponsored deal we've won. That's been our edge, is we know your space and we understand what you're planning to do with it, and we can provide that flexibility within the capital. For some sponsors, as companies mature, there's been a desire to take in pref equity, our ability to invest across the capital structure and be a one-stop solution. So we can do first lien, second lien, mezz, pref equity, common equity, the full gamut. And that appeals to most constituents, but even in the private equity scenarios now, there's a desire to, on the winners, to take in some pref, and we're gladly able to do that. With the families and founders we're working with and the independent sponsors that we partner with often, there our edge has been, one, to just be able to show up with whatever the capital needs are. And because of our ability to invest across the capital structure. In addition, a lot of times the equity check, because we're not a control investor, but sometimes an independent sponsor might need a control size equity check. We have family offices that are LPs that we partner with on a consistent basis to do that have a independent sponsor friendly buyout mindset. There's a family we're here with today that's invested with us in many deals, and that's what they like doing. So what we found is taking the time to build a network of family offices that are control focused, understand the independent sponsor model. We're able to provide a one-stop solution, and it's just more fun all around, honestly. I think that's been an edge for us. We're just sort of fun to be around as well. We understand your industry, we've been through your shoes, we've operated businesses. That tends to be an edge. Then when it comes to when it's a non-control, which is most of what we do, it really becomes not having a box that we're trying to invest out of. So we don't walk in and say, okay, we got a red watch, purple watch, pink watch, black watch. Don't ask me why I'm coming up with those colors. Is we go in and say our first two meetings will be, what is your vision? What are your passion points? What's your strategy? What are you trying to accomplish? So we say that for brokers, bankers, law firms, whomever we're working with, one of the first things we say is like, let's not talk about the capital needs in the first two meetings. So you can let your CEO, CFO, your client know that we're going to focus on what is the vision, the strategy, and where they're trying to go. Almost every single deal we've closed, we've custom crafted the term sheet because of our flexibility to invest across the capital structure. So that continues to be our edge. And so we differentiate in what is an otherwise a very competitive market, I would agree. Our competition, we face different types of competition. We don't compete a whole lot with direct lenders, but that happens occasionally. Regional banks tend to want the family businesses, so we compete with them quite a bit. A smaller private equity firm, because these are lower middle market businesses, may be interested in investing, so we tend to compete with them as well from time to time. But our edge tends to be we can custom craft a solution, and we know your industry, so we're able to stretch sometimes deeper into the capital structure needed.
Well, maybe just kind of to start to sprint toward the finish here. So wrap up, maybe just to give a little thoughts about, you know, what's we've talked about this summit, you know, what's going on currently in the markets. As I like to remind people, sometimes when people moan and groan, these are actually the good times, believe it or not. So I've been doing this over 20 years. So this is actually, markets are good right now. So maybe what do you see, and what maybe a little bit of just as we're finishing into the fourth quarter of 2017, what are you seeing out there?
Sure. Yeah, I think that it is very competitive due to the things we've already talked about. There's a tremendous amount of capital chasing what seems like a limited number of deals. You know, I don't know that the deal flow has grown commensurately to match the amount of people who are chasing it, both from a debt and equity perspective. So that said, I feel like at least at Crystal, we've seen a meaningful uptick in new business over the last 4 to 6 weeks. Beginning of the year was okay. Summer was a little slow. All of a sudden, everybody, you know, all of our teams and with deal sources across the country are seeing an uptick. Now, I have a strong suspicion that we're competing on those against a lot of people in this room and a lot of people in this city, and so it's not as though there's a whole host of new commitments out there. It's stuff that we're working on, issuing term sheets on. So that has us optimistic for Q4. It has us optimistic going into next year. But it remains to be seen if that'll continue for a while, and it also remains to be seen, you know, how we'll do on a lot of those offerings. But we're optimistic.
Thanks, Ken. Warren?
Yes, we tend to target trying to close 2 to 3 platform companies a year. We've closed 2 so far this year, so it's been a respectable year for us. And I think the only year we actually hit the 3 mark was 2008. That was our most active year ever, and it turned out to be the year right before the global meltdown. So doing a lot of deals may be a leading indicator of something bad to come, so we want to probably stop at 2 this year. But we definitely, we talked about the trends. I mean, it's tougher to put capital to work. We're probably having to work harder to put capital to work now than we did 10 years ago. And, you know, events like this are certainly something, you know, we weren't doing this 10 years ago. So we're definitely getting out there and into the community, doing a lot more networking than we ever did before. But probably buying maybe a slightly different type of company than we would have 10 years ago, to be honest. So maybe last 2 deals we did this year, probably a little smaller than we would have done a decade ago. So, you know, even in the mid-market, you know, there's pretty key or clear differentiation in terms of level of competition. You know, as deals get even a little bit larger, tends to get a little more shopped over. And you know, we definitely are gravitating more towards companies that may need a little more elbow grease to try and spruce them up after we buy them. Those tend to be the deals that are, again, less competitive and the ones that we are more gravitated towards. So the type of deals that we're looking at is probably a little bit different than it was 10 years ago. Those would be a couple of the key trends that we're seeing right now.
Yeah, at the risk of being repetitive, 2016 and 2017 have been measured years for us. We target 4 to 6 new platforms a year, and I think 16 and 17 are both going to be years where we do 4. We're happy about that in terms of just maintaining the discipline. And another factor is we are also finding ourselves, you know, that staying in the lower middle market where our edge is, we're even more focused on doing that. And so we're concentrating our sourcing efforts, concentrating our relationship building efforts in the more opaque part of the market. And partly is because of how competitive it's gotten. Partly it's because that's where we're most effective. So that's really been what's working for us. So the way we think about that is, if you're geeky like me and you're into prime numbers, 3 to 13 of EBITDA seems to be a safer part of the field than, I mean, it's really been amazing to see that even once you cross 10, 11 of EBITDA, just in the last 3-4 years, it's a monumental difference that's worked to your benefit in some cases, Warren, right, with the number of lenders that are willing to stretch on that. But in terms of finding new platforms to back, once it's above 10 million of EBITDA, 15 million of EBITDA, it's very, very difficult in terms of how to compete. So we're staying squarely focused where we've been winning historically, and we're being very mindful of the 16-17 vintage. We'll see how 18 shapes up. So we're at the low end of the 4 to 6 a year as well.
Great. Well, thank you, everybody. Thank you for your time and your attention today. It's been a lot of fun. Thank you very much to the panelists. Give a round of applause.